Hello everybody, this is Toni Turner and welcome to the market now as of about noon Eastern on Friday, January 4th. U.S. stocks added to their healthy gains so far today. So far is always the operative word lately. After Federal Reserve Chairman Jerome Powell's comment that the central bank will be sensitive to the downside risks the market is pricing in, that helped calm worries about slowing global growth. The market opened strongly after a better than expected jobs report added to the optimism from proposed trade talks between the United States and China, and those are coming up next week. And on that note, let's move on to three charts that could give us some insight into the week to come. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. This ETF tracks the S&P 500 benchmark index. Now we know that the SPY has fallen dramatically from its October lows down to this low it made on Christmas Eve day. On that day, on December 24th, the benchmark fell to lows of $234.27. That was at the close. That's about 2342 on the S&P 500 itself. Now, when the market reopened here the day after Christmas, the SPY held these lows down here at 234, and the SPY has rallied and then consolidated ever since. Now, that's good news. When I captured this chart today, the SPY was trading at $250.89. or about 2508 on the S&P 500 itself. Now, it has established here so far, after its move up, the SPY has established support at $243.67. That was established on the lows yesterday, Thursday. And it has short-term resistance up here at 251 from the recent little intraday highs that have been put in, and actually today's high so far was up right around 250, close to 252. So this is the part, and we discussed this last week, this is the part where we remember that the definition of an uptrend is price moving in higher lows and higher highs. And if that means if the market pulls back in the coming week, now it's bounced off these lows, if for some reason it feels like it has to move back down and pull back, it needs to stay above this support line at 234 or 2340 on the S&P 500 index. Needs to stay above that line. We need to remember the part here about higher lows. So if it pulls back, and pulls back to 240, 236, even 234, that will be fine. Below that, and then we have to get even more defensive. Now, hopefully that doesn't happen. Again, we have support here, short-term support, right about 243, right here, 243, 244. Ideally, that would hold, and ideally, the SPY would rise in the coming week, move back up over the 20-day moving average, which is coming in at $253.70, and move higher from there. That's ideal. Of course, price moves up, down, and sideways, so we could see a continuation of this consolidation pattern. Now, the market certainly looks positive at the moment, especially today. That's a good thing, but it is still volatile. Now note the average range of the SPY's trading days. Now, some days in this last volatile move, and some of these moves over here back in October and November, the SPY has moved 6 or more points between the daily high and low. And for the SPY, that's a large range. Now compare that to the days that it was trading here last summer, when each day was maybe a point or two in range. Okay, you can see how much more calm the market is when it's moving up and how much more volatile or fearful or wide price swings it has when it's moving down. That's because fear is stronger than greed. We have greed up here, we have fear over here. So since this SPY is still moving in relatively wide ranges between the highs and lows each day, and we all know we've experienced that, I'm going to stay defensive for right now. I'm going to continue my defensive strategy of entering any new positions with small share size and certainly always firm stops. Now when this volatility calms down, and it will at some point, then I will jump onto the offense. For right now though, I'm staying pretty conservative, and again, small share size, firm stops until I see how this next week or two plays out and whether the SPY moves lower or higher from here. Let's go on to our next chart. This is the chart of the QQQ that represents the Nasdaq 100. Of course, this has all of the high momentum trading stocks steering it around, like Facebook, like Google, like Amazon, like Netflix, Apple, and so forth. Now, the QQQ, like the SPY, fell down has been falling, I should say, in a very dramatic downtrend, gotten itself into bear market territory, and fell on December 24th to close on its lows at $143.46. Now, it held those lows the day after Christmas, December 26th, thank goodness, and then since then has rocketed higher and then consolidated pretty much like the SPY, the same pattern. And today when I captured this chart, the QQQ was trading at $155.45. Now, it is barely escaping bear market territory because at the moment the Qs are sitting at about 17% off of its prior highs up here. So bear market territory would be down in a lower arena. We're putting it down at 20% below the lows. Today we're at 17%. So at least it's still in correction territory, but once again out of bear market territory. Now, again, it needs to stay above the 143 lows here, right here, that came in on December 24th. And again, to stay in an uptrend, it needs to make higher lows. So it needs to make a low. If it does pull back next week, it needs to stay above 143 and then move higher. That would say perhaps we're in a reversal phase, moving back up to an uptrend, or if the trading gods are kind to us, the QQQ could move from here back up above its resistance line at about 156, move back up above its 200-day moving average and start higher, and that certainly would be preferable. So again, I'm staying conservative though, small share size, firm stops, because this market has shown an ability to go in crazy directions during each trading day, and I'm assuming nothing certainly at this point in time. So keep an eye on the QQQ and see if it can move higher. If it does, of course, that would be very bullish for the markets. Our final chart today is a daily chart of the S&P Spider S&P Homebuilders ETF. This ETF has 35 components, 35 holdings. Top components are Toll Brothers, A.O. Smith Corporation, Pulte Group, Mohawk Industries, Owens Corning, D.R. Horton, all of those kinds of companies in the home builder arena. Now, last January, you can't see it on this chart, but last January, the 52-week high for the XHB was $47.20. Recently, the XHB, the Spider S&P Homebuilders ETF, made a low of $30.56 on December 24th. Now that's a 36% drop. That's huge. If the Fed decides not to be quite so enthusiastic, we'll call it, in raising interest rates, that could be good for home builders. Now, it's rallied off those lows of about $30 since December 26th and has moved up higher from there. And when I captured this chart today, the XHB was trading at $33.40. Now, it is trading just below its 50-day moving average, the green line, and that's coming in at $33.82. As you probably know, the 50-day moving average overhead can act as a sort of ceiling for a stock or an index. You can see back here in November how it acted as a ceiling and pretty much yanked that, along with price resistance from the October highs, pretty much yanked the XHB back down. So we're going to watch it here. I'm going to watch it into the coming week. I'm going to see if the XHB can climb above the 50-day moving average. Again, that average is sitting at $33.82. If it can climb above it, I may add shares to my portfolio, and I'll place an initial stop down here. Going to make it fairly tight, an initial stop at 31.50. And then if price continues to move higher, if the XHB moves higher, I will trail my stop up underneath price from there. So you may want to keep an eye on the XHB in the coming week or weeks and see if it strengthens, see if it's something you're interested in. Again, I will continue to use small share size and firm stops. That is my mantra for right now. And now on to this coming week's economic reports, but please join us this coming Monday, January 7th, for our next session of Toni's Market Club. If you're not sure how to approach the market right now, let us help. We will tell you about which side of the market to trade, have a mini trading lesson, and I'll give you stocks and ETFs that may become ripe for high potential trades. Now, I am proud to say that during this move down in the market, which has been pretty dramatic, we were able to hedge our accounts, and we did pretty well. Toni's Market Club is a low-priced, high-value opportunity to learn more about the market, become a smarter trader, and make more money. So please join us. Plus, we have a good time. For those who cannot attend our live session, not a problem. The recording of our session is available to all of our members just a few minutes after the session ends. For more information and to join, go to tonysmarketclub.com. Now for the coming week's economic reports. On Monday, we have the ISM Services Index. Tuesday, not much going on economic report-wise. Wednesday, we have our usual crude inventories and the FOMC minutes in the afternoon. That sometimes sways markets. Thursday, we have jobless claims as usual. And Friday, we'll have the CPI, or Consumer Price Index, and the Fed does look at the Consumer Price Index for guidance. Again, please join us for Toni's Market Club this coming Monday. Don't miss out on this terrific opportunity to raise your trading skills and your trading profits. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.